We are diving deep into the cash surrender value option for the national portion of the life insurance exam. This concept is a staple of the non-forfeiture options section of the test, and you must understand exactly how it functions to avoid common traps. When a policy owner decides they no longer want to maintain a permanent policy, such as whole life, they have the right to take the accumulated cash value and leave the contract. However, the moment this option is exercised, the insurance contract is canceled and the death benefit is gone forever. This is a frequent point of confusion on the exam because students often mix it up with the reduced paid up or extended term options where some level of coverage remains. With cash surrender, the coverage is completely deleted. On the exam, you will likely see math problems involving the net cash value. To find the net amount, you take the gross cash value and subtract any outstanding policy loans and any unpaid premiums that are currently due. If a question asks what happens if a policy owner has a $10,000 cash value but owes $3,000 on a loan, the answer is that they receive $7,000. Another high-priority fact for the national exam is the deferral period. Most state laws allow an insurance company to wait up to 6 months before sending out the cash surrender check. Insurance companies are permitted this delay to avoid a run-on-the-bank scenario where too many people try to access their cash values simultaneously during a financial crisis. If you see a question asking about the primary purpose of this delay, it is to protect the financial stability of the insurer and its other policyholders. While most companies pay out within days, the legal maximum is what matters for the exam. You should expect a question asking for this specific time frame, and 6 months is the target answer. Taxation is another area where the exam will try to trick you. The general rule is that life insurance proceeds are tax-free, but that only applies to death benefits paid to a beneficiary. When you surrender a policy for cash, the tax rules change. You are only taxed on the gain, which is defined as the amount received minus the total premiums paid into the policy. This total premium amount is known as your cost basis. If the exam presents a scenario where a person receives more than they paid in, that excess is taxed as ordinary income, not capital gains. If they receive less than they paid in, there is no tax, but also no deductible loss. A common exam trap involves the timing of the surrender. The exam might ask when cash values must begin to accrue in a whole life policy. Usually, this is by the end of the 3rd policy year. If a policy owner tries to surrender a policy in the 1st or 2nd year, there might be little to no cash value available. You should also watch for wording that asks which non-forfeiture option results in the highest payout of cash to the owner. The answer is cash surrender, but remember the trade-off is the total loss of protection. To keep this straight, use the mnemonic, cash is the end. This phrase helps you remember that taking the cash ends the policy, ends the coverage, and ends the insurer's liability. Finally, be prepared for questions regarding the reinstatement of a surrendered policy. Most policies specifically state that if a policy has been surrendered for its cash value, it cannot be reinstated later. This is different from a policy that lapses due to non-payment of premiums, which often can be brought back to life. If a question asks if a client can get their old policy back after taking the cash surrender, the answer is no. They would have to apply for a brand new policy at their current age and provide new evidence of insurability. You might also see questions comparing the 3 non-forfeiture options. While extended term provides the most death benefit for a specific period and reduced paid up provides a smaller death benefit for the rest of life, cash surrender provides no death benefit at all. It is the only option that results in the policy owner receiving a check in the mail. If a test question asks which option is automatically triggered if the policy owner fails to make a selection within a certain time frame, remember that it is usually extended term, not cash surrender. The insurance company generally will not terminate your coverage and send you a check unless you specifically ask for it in writing.